So now it's the time for the presentation, and the presentation by Mr. Sandeep Tandon, founder and CIO Quant Group. A very wonderful presentation. I'm sure it's going to be very, very powerful for each one of us. It is dynamic style of money management. I learned, years ago, I learned one thing from Rao sir. Today we are working for money, but tomorrow money should work for us. Do we all want money to work for us? And that's why we all are wealth managers, aren't we? So let's learn the dynamic style of money management and hope you have a great learning from this presentation. And Quant Group and Sir has been known for his very, very different style of investing for their investors. So it's dynamic style of money management, new investment mantra of 21st century, and give us a glimpse of future-proof investment approach to stay ahead of the competition. Rao sir, I stole this line from your video. Money should work for us tomorrow.
So, as I said, we all live in a very dynamic environment. Okay, we understand data is changing, everything is very dynamic. Then why our money management style is very static? Okay, when I say money management style is static, we all have grown, including myself, believing in one thesis, unidirectional approach. What we call it, a lot of people call it fundamental. We call it valuation analytics. So we have grown with one unidirectional approach, valuation analytics. And the challenge with valuation analytics is a backbone for us. We call it fundamental, the Atma, liquidity, the prana, and sentiments, the maya. So it's a backbone. But other things are equally important. Okay? When we talk about valuation analytics, it is dependent on one dependent variable called price. And if it's dependent only on price, then our view is biased. Okay? When price is correct 30-40%, then you realize that sector of stock has peaked out. What happened in September 2019, whole 2021, whole world was very gung-ho about technology, and after 5-6 months, you realize that was the peak of that cycle. Okay? So post-mortem analysis is very easy. Now, criticizing these things is very easy, but what is the solution for that? Okay? So we have to bring an independent variable to remove your biases. Okay? That's the way we bring a lot of macro data. So we bring 2/3 weightage we give to our macro analytics, which is independent of the price. Okay? And this really helps us in balancing our approach, where we give weightage, 1/3 weightage should be given to your valuation analytics, 1/3 on the sentiments, which is risk appetite, and 1/3 on the liquidity. Okay? So liquidity is very important. Okay? That's the way, again, I just want to rephrase our core belief. We call fundamental the Atma. It's like your fundamental basic stuff. Liquidity the prana, okay, and sentiments the maya. Maya is equally important, but can you quantify it, maya? Okay, you can feel it. I'm very bullish, bearish, global market has changed, okay, but you can't quantify that part. You're able to get it, the presentation? Okay, no problem. It's okay, fine. It's okay. So, let me give you a very live example when we talk about dynamic style of money management. The whole idea is to bring multivariant and multidimensional, which leads to a better analytic sense and leads to a better market timing. When I talk about timing, it's not about trading. Timing is about risk mitigation metrics. When you time it better, you can reduce your risk. So let me give you a very classic example, and you all can check that. In March 2020, when COVID unfolded, we hit a lower circuit on the exchange on 23rd March, and 24th we made a low. By end of March, we spotted that if I have to go by mathematically, the risk appetite for the global market was multi-decades low. For India, it was 40-50 years low. And this is a macro number, so it's not coming from your gut feel. But you all remember that the fear factor was very high. We were all worried about life. There was no clarity. We all know this is a brilliant opportunity, but we didn't have guts to buy even one share in the market. So risk appetite is a reflection of your conviction level, confidence level. If I have to say from behavior perspective, we measure it mathematically, that's a different issue, but you can quantify, you can feel it, risk appetite was low. Now look at that, and obviously what valuation has changed? Answer is no. Nothing got changed immediately. Yes, the impact of valuation you will felt down the line 6 months or 1 year, you realize something has changed, and that is what we call it a post-mortem analysis. Now look at simultaneously the liquidity. Because of central bank, all the global central bank, because of pandemic, was working together, and it was also part of post-Lehman crisis, most of the central bank came together because Lehman was a liquidity sucking event and liquidity dried up and that event unfolded. So liquidity was lifetime high, okay? And when liquidity was lifetime high, risk appetite lifetime low is a classic combination for a massive bull run. That was the foundation for a bull run which started in April 2020, and retails are the leader for that segment. I'm just trying to quantify, I'll talk about that. Look at now what happened as event unfolded 2021. I talk about September 2020 world. We were all very euphoric, okay? Market was lifetime high, global market, Indian market, technology stocks were booming, everything was very hunky-dory if you have to ask me. And people were very excited. Maximum strategists have upgraded India, okay? That was the classic time. Now if I have to quantify mathematically September 2000 or October 2021, what got changed? Right from February 2021 onwards, liquidity was started drifting down marginally. Risk appetite had started shrinking of August onwards. And by September, October, there was a euphoria in global equities. So when you dissect this euphoria into very simple terms of value or growth, we spotted that euphoria was confined to growth or new age company or technology company, not in value, okay? We can get into sectors and other things, that's a different thing. So September, October 2021, liquidity was shrinking, risk appetite was declining, okay? Valuation was at significantly high levels, and money flow has peaked out. It was the classic money flow towards global equity. We quantify these things, what's at multi-decades high. And that was the classic top for the growth stock or the most admired category stock in 2021. Let's come 2022, June 2022. What happened? We spotted by mid of June 2022, we saw exhaustion in liquidity, exhaustion risk appetite, valuation became attractive, and we spotted that we are reaching an inflection point, okay? And we saw a rally globally, including India. Come September, October 2022, 1 year exactly later, the Quant fear index or capitulation index for US market was as high as what happened in March 2020, okay? So again, a very classic opportunity. It's a lifetime opportunity to rebuild your position. And we talked in the media, the 15 to 20% rally in US market. And since June, you see how India has performed. And this is what we talk about, that we have to change ourselves, okay? Now, if you really look at when we talk about valuation aspect, you know, yeah, thank you. See, we keep on hearing in the media, oh, valuations are rich or cheap, okay? This is very simple, everybody understand. By September 2020, okay, when market has rallied significantly post-COVID event, everybody in the media talked about, it's again post-mortem analysis, is a liquidity-driven rally, tsunami of liquidity, okay? Then, in 2022, everybody talked about how liquidity has been sucked out, sentiments have turned bad, okay? We all understand and maybe react after that event is over, okay? But we don't make any changes in our portfolio because we say, no, we are long-term investor, okay? We are not making fun of long-term investor. This whole thesis is wrong, okay? Stocks and sectors are not long-term. It is the equity and asset class is long-term. You should be very clear, an asset class is long-term. So somebody says, lever is a long-term. No. Lot of things have changed. You can say this is a classic MNC stock, long-term story. Nothing is static in life, or you can say it can last forever. So we bring the concept of dynamic style. Data changes, we will change our opinion. And that generate alpha, and that generate reduce the risk. And that is the thesis which is building up. India people, we are the few people who are one of the first to start something called dynamic style. Globally, this concept is also new, but a lot of people in US, this concept is evolving about adaptive alpha, how you generate adaptive style of money management or adaptive asset allocation, we call it. So we are the strong believer of that. Let the presentation started, I will talk about few things. So this is the cover page of a book which we written in 2019 called Being Relevant. But being relevant is our philosophy. Everybody wants to keep himself or herself relevant at all given point in time. But trust me, it's not easy to maintain that relevance. And that's the reason relevance is very, very important in our life. Relevance at all point of time to generate similar alpha or generate that sort of return. So this is where we come from. So when we talk about in a dynamic world, there's no need for any subjectivity. I'm very strong believer of that. When people say it with my experience, I'm telling you. Okay? Mera experience, I can talk in Hindi also equally well. Okay? So people talk about mera experience, okay, batata hai. Okay? Mujhe lagta hai. Ye best of the analysts bolte hain. This is the way gurus are telling us. Okay? So we are all have some biases which got evolved over a period of time. Okay? And we started believing those biases. Something has worked. Somebody say, oh, 8-year cycle works. In 92 it happened, 2000, so 2008, so it becomes a new benchmark. 8-year cycle works. These are all myths. Why didn't it work in 2016? Okay? So when we carried these myths in our mind, the problem starts. Okay? So we talk about that when you talk about investments, okay, it has to be quantified. There is no space for subjectivity, my view, your view. Everybody's view is in dustbin, there is no value. Show me data, that's the way world is all about. In today's data analytics world, the young generation understand that thing far better than me also. So this is all about data analytics. So we talk about objectivity is our new religion and data is God. Everything revolves around data. Everything has to be quantified. That's the way what Quant comes from the background. We quantify everything. It's not about quantitative techniques alone. A lot of people think this way. But we quantify everything, including sentiments, climate change, weather condition, geopolitics, anything you can think affects market. We are trying to evolve ourselves and learn how it affects markets. Okay? Our focus is market, nothing more. We don't have to write a white paper on that. So a mid-fresh approach. So dynamic style of money management, when we say it's a data-driven approach, a data analytics company. Okay? So in a mutual fund, you are all advisors, and I have been in this business for a while, for nearly 3 decades. Everybody go and sell products. As an advisor, you go and talk about this mutual fund or with this product delivered this much return. This is the track record, or this is the IR you can expect. This is what we talk about. That's the way the problems start, because we started selling returns. We are giving a message that we are in the business of suggesting you better products. We do reverse. We believe that we are in the business of risk management, returns on byproduct. And if we can understand this mantra well, if you manage your risk better, returns are byproduct, you will do a far better job as an analyst or as an advisor or managing money when you understand the importance of risk. We all talk about risk, okay? In the last line we write, read the circular or read these things, risky assets or thing, okay? That disclaimer will come, okay? We are strong believer, risk management is our main business, returns are byproduct. That's the way we defined at Quant Mutual Fund, okay? So we acquired Escorts Mutual Fund some 2018, and since then it was 140 odd crores. We have grown, so let us skip this side, okay? We recently got the Lipper Award for the Equity Highs of the Year. It's a very young firm to getting awards, okay? Let's come back and I'm talking about a dynamic style of money management, okay? So idea is very simple, how to add alpha and subtract beta, okay? How to generate superior risk-adjusted returns. We can take risk and generate extra alpha. Answer is yes, but it can backfire. So minimum risk and optimization of risk management, that is our core mantra of dynamic style of money management. Okay, just give you a performance, so when we talk about talking is very easy, it's a performance, we could be the only mutual fund whose all the schemes are the top quartile, and most of the places are we are number 1 in 3 years and 5 years category, okay. Very interesting data, and what we have taken is that, okay, it's not working, 1 minute. No, it's not working. No, it's okay. Can you check this? Yeah. So let me come. No. This is working, but the light, yeah, is there now. Okay, it's fine. Fine. Thanks. So if you look at our performance, we have taken March 2020 bottom, where we hit a lower circuit on Bombay Stock Exchange on 23rd March, and 24 was the bottom. So we have taken a cycle, and this return is still there for yesterday. So you just understand what sort of return, small cap, 439% return, 294. The returns are very interesting. What is more important is the outperformance. Okay, the outperformance of 300%. Industry has seen outperformance of 8-10%. a 300%, 200%, 250% outperformance industry has not seen. And this is the outcome what we bring, a dynamic style of money management where you control risk and time the market better to reduce the risk. And very important to understand, the outperformance is very good. What is more important is the lookable Sharpe ratio or Sortino ratio, or even if you want to look at the Jensen alpha. Statically, it'll give you answer. We are top notch out there, okay? So what risk we have taken and what returns we have generated, that is very important. With limited risk, we have generated highest return in the industry, and that is the byproduct which we talked about. If you manage your risk better, returns is a byproduct. So this is the thing. Let me take to you few more examples. So we talk about predictive analytics, okay? Now I'll give you perspective how predictive analysis thesis work, okay? If in your childhood days, in your kindergartens, you used to have a drawing book where dots are there and you connect the dots, some picture emerges, apple or house or tree, whatever it is. And you go to the kindergartens to upper KG or lower KG, and then obviously the number of pointers increase and you get a better, bigger picture. This is exactly what we do. We connect the dots, both dependent and independent variable, macro data, company data, geopolitical data. You can think of a data we try to capture. As much data is better, so we reduce the noise level. And when we connect these dots, you see a picture. That is the strength of predictive analytics. In today's world, a lot of people use as AI or machine learning or big data. We have been using it for the last 30 years in trying to see what is coming, and that is very important for us. So when we talk about we live in a dynamic world, you see how it's changing, you know. This is a picture of Wall Street. We're trying to, this is the last page of our book, we are trying to showcase that people have lost their job and we are hiring. And what we are hiring is very important. We are not hiring valuation analytics, okay? What we are hiring geopolitical analysts, we are hiring cycle analysts or perceptions analysts or geomagnetic analysts or volatility analysts or liquidity analytics, okay? I'm just trying to give you glimpses, you as a budding advisor or trying to see what is coming. This is the way industry is coming. This is the way changes are happening, okay? So your primary style of research is over, or secondary style, everything is online. Let's talk example, GST data comes. We have already given, government is working on the suggestions, okay? If GST data comes after 6 months, 1 year, we are say release the data same night. Which area, which product, without naming of the shop, what product, which brand got sold. So just imagine a scenario that every night you have tons of data, how many people are prepared to analyze the data same night and react tomorrow morning. That is the strength of analytics. That's the way world is moving. And we are one house who's prepared for that. We spend every year $1 million on data analytics. So as I said, we quantify A to Z of financial market, anything which affects market sentiments. It has been a trend when people talk about, you know, how climate change affects. And every platform, political leader, business houses talks about climate change, weather condition affects market, but nobody quantifies. We have put in nearly a decade to quantify how it affects market, how magnetic fields affects markets, okay? So when we talked about the current decade from 2021 till 2030, will be the most challenging phase from the Earth analytic thing. Mother Earth is extraordinary changes are happening. That's, you have seen some of the event of extreme cold, extreme hot weather, extraordinary wet weather. We have already entered what we call it from a climate change perspective, cold and wet weather, where efficiency will collapse globally. Okay, this is a new challenge which you will see. So something we can talk for hours since we have limited time. So let's come back to our framework which talk about risk mitigation framework. Okay, we have been taught timing is bad. Nobody can time the market. Okay. But every trader, every investor, every man sitting in or lady sitting in this room wants to time the market. Every businessman wants to time the market. Every trader wants to time the market. We always say right place, right time. This is all what, nothing else timing. This everybody wants, nobody wants to accept it. We are very vocal about it, okay? It is there in your deep subconscious mind to time the market. Our timing is not trading. Our timing is all about how can you reduce your risk. We sold technology stock in September 2021. We could be the only mutual fund we exited the entire technology stock in September, October 2021, and we moved towards banking and ITC in our portfolio. The outcome is very different. So if you say timing is not important, I will say take it to the next step. People talk about 80-20. 20% stock gives you 80% of the return, or 20% people gives you 80% of your productivity. I will take it next step and say only 20% time any stock gives you 80% returns. So if you miss those 20% times, you have missed the biggest outperformance. This was the case what happened in ITC. People used to make fun of ITC. Best cash flow generating company. It is 8-9% of our portfolio. We spotted it was in the most neglected territory. In 20 years, we got 2 times that opportunity to optimize. One was in 2007-8, and another was in 2021. So timing is all about risk mitigation strategy. Okay. This is a phrase which talked we about, so I'll skip it. So this is a very simple investment philosophy we bring. We manage money very dynamically. Okay. 2 more minutes I will take. Okay. Let me just show you the last slide. Okay. A VLRT framework. So we are, as starting in the beginning, I said we give 1/3 weightage to the valuation, 1/3 to risk appetite, 1 to liquid. We all hear in the media, these things has changed and we don't change over. This is what we do, a dynamic style of management, which leads to a more churn. Because we have been taught another wrong thing. Churning is bad. Oh, churn is very high. Turnover is high. It's nothing to do with a risk management. There is no portfolio management books who talks about churning, talks about rebalancing. A private equity rebalance their portfolio in 5 to 10 years. A trader rebalance portfolio on daily basis. This is something which we want to talk about. So I will take a very last slide and just conclude this thing. It's our investment process. So we look at the global risk appetite, we look at the global liquidity, comes to the India, same thing. Very important to understand whether it's a risk on environment or risk off. In risk on environment, which was the case in April 20 till September 2021, you play on front foot, generate extra alpha for difficult time. And the difficult time started from November 2021, okay? So this is the way we can, since we have very limited time. If anybody has any question, we are happy to answer 1 or 2.
So one question on behalf of everybody.
Yes.
What are 3 things which makes you such a good performing fund house? Right? Because we always see you are the contra, right? Everything goes down, you go up. What are those things which actually...
So it's not contra, it's a data.
Okay.
Okay, it's a data. Like I said, I've been saying in the last few months, whole media was very negative about global market. I said media noise or the narrative is very negative, but data is not. Okay. So quantify, ability to quantify everything gives us that edge. Okay. So 3 things I said, we don't look at anything in isolation. We believe that everything has to be looked in tandem. You know, the problem starts with the industry which says, I know this much. So whatever people know is a human phenomena. Whatever I know, I say this is my fundamental. All guys are do technical stuff. Okay, that's a standard answer industry gives. Okay, in everything in life is fundamental. If you say a currency trader is a pair guy who looks at economic data, so people demean him as a trader. But he is the guy who retired at the age of 30. His reflexes are so sharp. Okay, he's the best paid guy in the world. People demean him, but ultimately he looks at his data. For economists, his or her data is fundamental. Okay, so we call it that you have to look at in totality, just saying that skewed data on one. When multiple data gets skewed on one side, better timing and better output.
Thanks a lot, sir.
Yeah. Yep.
Now, again, market is at all-time high, and all the central banks are raising their rents. Now, what will be the future of the market?
So we, as you hear, a lot of investment gurus are talking about, and we were also very early to talk about. See, globally, global headwinds are extraordinary. We have talked in 2019 how this decade will be, okay? But you have to understand, India, the more the problem West faces, there's an opportunity in India, okay? India has unique advantage currently, both in absolute basis as well as relative basis. So if even I will tell you ki whatever trailer you have seen of high interest rate or inflation is a trailer only. The big ugly picture is spending, but it's not happening tomorrow morning, okay? Because the consensus is already built. Every central bank has started working against that, so it will not happen now. It will happen maybe down the line few more years, okay? The cycle which, so you are globally, interest rates and inflation on a globally secular bull run, okay? Not the case in India. So this decade belongs to Asia, this big decade belongs to value theme, this decade belongs to emerging market and India-centric emerging market. So India is in a unique situation to optimize that opportunity. So we will also have impact. If there is a people going to vomit in Europe, you will see a stink out here also. Yeah. So one should not be very complacent that we have arrived and we are decoupled now. And when there is a crisis, you say we are recoupled. So that complacency has to be avoided. But structure thesis remain constructive for India, because in very difficult to explain in few minutes or few seconds about it. I have to just conclude the impact of interest rate inflation will be less felt in India as compared to global market, because we have already seen, if I have to look at from a risk appetite perspective, developed market, US particular, Europe has seen extraordinary risk appetite, that money will shift from high risk to low risk environment, how water shift from mountain to valley. Similarly, money will shift from high risk to low risk environment, which is Asia and India in particular.
But sir, interest rates rising, inflation is rising, then how our market can get 25-30p multiple?
So, as I said, this is the time, if you watch my videos here and there, we have said this is the time for value thesis. I also talked out there that the extraordinary, what I call it, more admired category, high P multiples, so that phase has peaked out. So that's the reason PSU banks are outperforming than the private sector banks, okay? So this is the thesis which will evolve. So it's when you talk about risk management, the way we look at through sector rotation will play out. I'll still generate alpha. We are least bothered about what happened to high P multiple stock, because we have seen the trend. We are early to spot that trend and rebalance our portfolio.
But sir, I'm talking about index P. See, GDP is growing at 6%. So 9 to 10% inflation, 6 plus 10, 16. So maximum 18, 19p.
So I'll give you answer. Yeah. The problem which you are looking at limited data points and concluding.
Okay.
When we look at multivariance model, we are not bothered about just 2 data points. When multiple data points skewed on one side, so when you start looking at 1 or 2 data, you don't get answer. When we look at multivariant answer, we get a better answer. That's the reason we have tried to show how we look at India. Let's focus on India. Let's not bother too much about global market, but we are not ignoring. Okay, I said if you see people who vomit there, you will have stink out here. If market collapse, you have an impact. Okay, so it's not going to be linear journey, but India remain constructive and buy on dips. So don't get too much irritated or agitated about US interest rate, but don't celebrate also too much. Okay, that's the way I look at it.
I think, thank you for the question. Yeah. So we are all proud to be Indian. Thank you so much, Sandeep sir. I know there are many participants who wish to ask questions from Sandeep sir. We don't want to leave him, but because of time constraint, I think we have to leave it here. Thank you so much for your wonderful presentation, sir, on evolving approaches to investment to survive and thrive in the midst of market uncertainties. And today we have learned a new religion. Have we learned a new religion today? And that's A to Z of the? Sir has showed one slide, A to Z of the market. Have we seen that? Are we all ready to follow that religion and learn A to Z of the market? So upskilling is not an option, but a necessity. I would keep saying it till evening.